Hi, welcome. My name is Jonas Thulin. I'm head of asset management here at Erik Penser Bank, and I will try to briefly and very shortly give a snapshot of our house view and how we allocated money. We have a couple of new trades on the table that I want to bring to your attention. We have bought healthcare in the Eurozone almost a week ago, and we also bought a US curve steepener, unhedged in dollars. Now we try to explain why, basically. First of all, I think we have a good track record so far this year. We are, of course, down on the year. If anything, to be perfectly honest, I think we could have handled our hedges a bit better. We had a tremendous run when the awful war started, but then we've given up a sizable portion of that. Now the quarter-end flows, they're sort of distracted and sort of a little bit of mess of our dollar positions. But still, that's something that we're self-conscious about and we work a bit harder on. But we're still delivering about 8% per annum above our index, and we are on that speed given Q1 as well. Now, in terms of drivers on the equity market, it's not geopolitics. We have discussed that a couple of weeks now. We can see clear the statistical relationship between geopolitics and the equity market has completely withered away. Geopolitics as a factor has been halved in risk given a week ago, which you could argue is absolutely absurd or weird, but in our world it is a little bit of what it is. So basically geopolitics is withering away as an explanatory power for the equity market. Obviously the human tragedy is something completely different, but here we're focusing on the capital markets. Now inflation has also come up and as a sun and then plummeted and sliding down quite rapidly as well, and now it explains about 5% on the equity markets. That's not driving things either. Now what is driving the whole equity market is financial conditions. You all know that we had VIX and dollar as our hedges because they were pulling down financial conditions, so we can flip the sign on those two, a bit bluntly expressed. But right now we have a positive momentum in US financial conditions. We do not have that in Europe, i.e. we're still heavily overweight US. We have zero here exposure in Eurozone, which is not true. We have bought Eurozone healthcare, which is obviously the strongest trend we can see now in the equity market, apart from Latin America and so forth. It's actually stronger than energy for the time being, which is quite interesting. Now this gives that the relationship between financial conditions, also by subtracting the equity market from the financial conditions, sort of more of a pure financial conditions, and the equity market is quite high. It's coming down a little bit. What has been eating away here on the edges is the US political risk is rearing its ugly or pretty head, depending on how you view things, but it's definitely becoming a little bit of a factor as we're approaching midterm elections and so forth. You have Supreme Court justices being appointed, you have Federal Reserve as well, which is sort of also on people's mind. Now, importantly for us, we agree with Goldman Sachs and other US investment banks that are claiming that this data print for the CPI will be the peak. It has been front-run by break-evens, as you can see in 2 years. We are doing a trade on this on the fixed income side and alternative side by trading the curve steeper in the US. But we're keeping sort of the inflation equity strategies in terms of emerging markets, Latin America, US farmers, and so forth. So we're not completely giving up on this high inflationary exposure because we think that's a bit jumping the gun a bit too quickly. I think with the curve steepener is enough to begin with. And why the curve steepness? Well, basically what happens now is that the short end of break-evens is falling back a lot more rapidly than the longer ends. So you have this idea that the 2 years sort of falling, but the long runs, because they haven't climbed, because inflation wasn't all that sticky to begin with. Maybe I shouldn't even mention the word transitory, but at the end of the day, even though the transitory was a prolonged period of time, it is a little bit still the name of the game for the bond market, that we don't see this sort of the 2 year being spilled over to the 5s, 10s, 20s and so forth. So when we change the shift or the sign on all these things and we're going to start to unravel these positions, you're going to have from a curve flattening to a curve steepener. Now, obviously, this is also depending on we think that we have reached peak hawkishness from the Fed. We calculate that by using natural language processing. which has been run on the bank minutes, and that's indicative of we actually reached peak hawkishness. That means that we are supposedly starting to see the end of what's being priced in from the Fed. As such, the risk reward is turned to the other side. So should we be long the short end? Yes, that is certainly the same thing, a little bit the same thing as what's driving in our mind Tuesdays. Again, we could be horribly wrong on this, but we think it's definitely worthwhile dipping our toes into this. We have a small position on it. Why we think the Fed will not hike as much as being priced, it comes down to credit risk. We spoke about this a week ago. For us, the credit risk is apparent if you look at real estate in US speculative cities. If you look at the tranches with the most credit risk, we can actually see quite a big move already in credit risk, as you can see in the green, as if the Fed had already hiked. Now you can argue the Fed has already hiked given Fed Fund futures. But in our book, and it was also been this sort of historical place that the Fed likes to talk tough, but when they look at what the market has already done for them, they can sort of slip away from actually having to deliver some of this toughness. And I think that's certainly worthwhile looking at. So there's a great article on this on Bloomberg a couple of weeks ago. Now, so our bet is that the left-hand curve is indeed spurious in the name, or sort of using the name, the word from the Fed, that the relationship between that and the equity market and the business cycle is indeed spurious, and then we have to depend a lot more on the 3-month, 10-year, or the shorter end curves, like OESs and forwards, i.e. you should have had the steepener going on here. So basically we're taking a view on the 2s10s that it should shift and look a bit more like the 3-month, 10-year. Again, we're very humble that this is a quite interesting bet, but it's certainly interesting to do. We actually keep it unhedged in the dollar, which is sort of a little bit of a hedge versus that position it by itself, because it's a bull steepener that we envision. So we will see how that plays out. Now, why on earth did we do it? Well, as I said, price inflation has shifted the sign and has been bouncing back. That means to us that we should lean back and wait for nominal yields to discover this. And as it does, we should have a steepener. Now, a steepener can come from both ends. We believe in a bull steepener. It could also be a bear steepener if you look out. Well, that's actually what's happening right now in the 10-year. So we're going to have this is going to run a little bit wild for us, and potentially if it doesn't change into the character that we envision, we might have to take it off because we like to control it as good as we can. But that's a new trade on top of the healthcare sector in the equity market. And just to give you a little bit of a feel for it, but the position we have in the European healthcare sector on the equity side is about 10 times as big as the curve steepener. So this is a small position for us, of course. You still have the big spread opening up, and I actually think this could be a theme that we will discuss a lot more later on in the year, and that's the reversed globalization, that we do not see a globalized world anymore the same that we saw a couple of months ago. There are talks now in the market, as you probably have seen, about different islands of economies, like you have the regional, the North American region, you have an Asian region, and European region. And that will become more, setting the tone a lot more than the globalization trend as such. And I think it's interesting to view how the market is making a clear spread between US and European equities. You can see here in the graph the statistical relationship between the two is very, very low. We're calculating here not only direction, but also the magnitude of the move. We can skip this. On top of this, we are sticking to our overweight equities. And why on earth are we? Well, because when we read the Twitter sentiment and calculate on Twitter sentiment on the top 200 companies in the US, we can actually see a leading indicator for the the equity market sentiment. And we believe that it's actually going to turn back up again and come back to the highs that we saw since 2021. This will be quite interesting to see. That we were fortunate enough to use this when we hit the trough on the 9th of March, etc. But it'll be interesting now to see if it actually carries fruit again or not. On top of that, because we don't trust Twitter sentiment and all that to a large degree, we also look at rate spreads like CDSs on corporates. We have here, in fact, FX, well, fixed income, or emerging market spreads. That troughed and rebound on the 9th of March, which is also quite impressive kind of move. We saw this kind of risk index, so that's also constructive. If you like fear and greed monitors, please take note. It's back positive. It hasn't been positive since last December. So all these signs start to line up for a constructive view on the equity market, which is why we keep it on our own weight on the equity side. And the things that we added, as you can imagine, are our European healthcare sector and so forth. Encouragingly, behind all this is that the equity flows that we see right now, if you compare it to the flows in the fixed income market, it's the strongest equity relative fixed income flow we've seen since 2013. We had a small period of outflows from the equity market, but since then there's a huge flow going into the equity market, which is quite interesting, we think, and quite constructive as well. Now, if you look at the upcoming earnings season, we are positive. That is because we believe that there's a way of calculating whether or not the corporate reports and earnings will surprise the market positively or negatively. The blue line here is our predictor for the underlying positive surprise momentum on the US earnings season. The blue is no magic or anything. It's basically what we do is that we derive it from listening to the corporates. What do they tell us in terms of profitability and earnings? And that's what we model versus the reporting season. So at least there's a positive sign there as well. On top of that, we are also constructive on earnings revisions, given this continued strength in the business cycle. Now, the business cycle has gone from strength to strength, and I'm very aware of that. There are a lot of talk about the recession here and the recession there. There are various ways of calculating the recession risk in the US. This is probably the most bullish one, but I like to show it to you because in the last week we dropped our recession risk from 15.9% to 5%. It's the fourth lowest reading since 1970s. It's purely built on credit risk in the US. So if anything, you should come to the conclusion that in terms of credit risk, there's very little credit risk now in the market, despite inflation, the move in the 10-year, etc., which is, I believe, a very constructive signal, also given how much we priced in terms of Fed fund futures. It's also quite interesting that this signal came around the week that we had a lot of sell-side analysts going out there and talking about recession here, recession there. We tend to trust more on the market side and what's actually being priced. And this is just one of those great weeks where we saw a clear spread between what we can actually see and calculate coming from the market and also what's happening on the sell side. Now, if you look at other indicators, the ones the Fed have basically built on the US rate curve, the probability of recession is a little bit higher, about 15%, but it's still very low, and that recession risk is valid for 2008, 2023, and 2024. So far, the environmental situation is well controlled. Will it be that when they start hiking a bit more aggressively? Well, we have to wait and see. But here and now, I think it's way too early to become more pessimistic in that sense. So we're sticking to our outright call of being a maximum equity allocation in the portfolios. Because obviously, I skipped that slide here, but we have to remember that even if the two stance is 100% correct in the sense that we're going to get a recession, the leads and lags behind a curve inversion like that, and the actual economic outcome is about 330 trading days up to 600 trading days, during which period equity markets normally rises about 36%. So even though if we want to be bearish, we have to time this a lot more careful than just making a call today and then forget about it for about 6 months and then say, yeah, we were right, we have to be long or short. So right now we chose to stick to long, basically. Now that was it, and we will be back in 2 weeks due to Easter, so we wish you all a happy Easter, and more content is on our web pages and also my social pages, so please have a look there, and I look forward to see you all in 2 weeks' time. Thank you.